Hey everyone, welcome back to Corporate Decoder, the place where we unravel the mysteries behind public company filings and let you know what is really going on. Today we're diving into a 10Q report from Pineapple Express Cannabis Company. Now, you might be thinking cannabis, but let's just say this report has a few more tricks up its sleeve than just talking about plants. Stick around because we're about to see if this company is growing strong or if it is just burning out. Before we get into the weeds, if you love getting clear, no nonsense insights from complex financial documents, make sure you hit that subscribe button. And hey, we've got a growing community over on Discord, linked in the description below, where we break down these kinds of things further. Come join the conversation. Alright, let's jump into this. This is a quarterly report, a 10Q, and it is for the period ending the 31st of October, 2025. Think of it as a quick snapshot of how the company is doing right now. So, Pineapple Express Cannabis Company, they're based in Nevada, and their main business seems to be an AI-powered data analytics platform for the legal cannabis industry. They're trying to provide market intelligence using blockchain and machine learning. They've also got some involvement with tokens, which we'll get to. Now let's look at the numbers. When we look at their balance sheet on the 31st of October 2025, total assets are listed at $190,000. That might sound small, but compare that to the 31st of January 2025, where it was zero. So they did acquire some intangible assets, specifically intellectual property worth $190,000. But here is where things get interesting. Their total liabilities at the 31st of October 2025 are a whopping $8,344,100. Now, back on the 31st of January 2025, that number was just $2,079. That is a huge jump in liabilities. And this leads to a substantial stockholders deficit. At the 31st of October 2025, it is a negative $8,154,100. This basically means what the company owes is way more than what it owns, and that is not a healthy sign. Moving on to their income statement, the picture for revenue is pretty stark. For the 3 months ending the 31st of October 2025, they reported zero revenue. For the same period in 2024, it was just $4,332. Looking at the longer 9-month period for 2025, revenue is also zero compared to $16,168 in 2024. Very little revenue being generated. Their operating expenses for the 9 months ended the 31st of October 2025 were $319,970. This is a big jump from $16,740 in the same period in 2024. A significant part of this increase is due to management fees, professional fees, and stock for services. And with those expenses and minimal revenue, the net loss for the 9 months ending the 31st of October 2025 is $622,176. In the same period in 2024, the loss was much smaller, only $572. This widening loss is something to watch. Let's look at cash flow. For the 9 months ending the 31st of October 2025, net cash used in operating activities was $938,654. This means they spent way more cash than they brought in from their core business operations. In investing activities, they spent $190,000, likely on that intangible asset. Financing activities were mostly about taking on debt and other financial obligations, ultimately using cash. And here is a really critical point. At the end of the period, the 31st of October 2025, their cash and cash equivalents are listed as zero. This is a major red flag. It means they have no readily available cash. This brings us to the going concern section. The company's own financial statements state that they have not generated enough revenue to cover their operating costs. They rely heavily on getting more money from shareholders or loans. This is a common phrase in these reports, and it signals management has serious doubts about the company continuing its operations for much longer without more funding. They're saying it themselves, they might not be able to continue as a going concern. One of the biggest issues here seems to be their debt. At the 31st of October 2025, they had a convertible note payable of $3,723,597. These convertible notes have a very specific and concerning footnote. Footnote 2, which states that upon an event of default, the borrower has to pay 200% of the outstanding principal plus interest and fees. This sounds like a debt trap. They also have a derivative liability of $3,050,762. This usually comes from things like warrants or options that are treated as liabilities because they can change in value significantly, and it is a pretty large number compared to their other assets. Then we see the impact of these convertible notes and other financial instruments. At the 31st of October 2025, the company reported a derivative liability of $3,050,762, up from zero at the beginning of the year. This volatility in derivative values is a key indicator of financial risk. Looking at the convertible notes detail, a lot of them are quite old, with maturity dates stretching back to 2017, 2019, and 2021. The critical part here is the cross-default clause. Basically, if they default on one loan, it triggers a default on all of them, and they have to pay 200% of the principal plus interest and fees. This is a very aggressive penalty, and the note holders are entities like Carpathia LLC and JP Carey Enterprises, Inc., along with Joseph Canoes, who seems to be a manager for these entities. These are the people who hold the company's debt and are looking for repayment with some very steep penalties if it is not paid on time. Now let's talk about their internal controls. Management itself admits that they have material weaknesses. They don't have an audit committee, they haven't maintained appropriate cash controls, and they're lacking proper information technology controls like data backups. This means there is a real possibility of errors in their financial reporting that might not be caught. Specifically, they highlight the absence of an audit committee. While not legally required for all companies, it is a critical function for oversight. They say the board of directors is acting as the audit committee, but lacks independent members, which is a significant governance concern. Looking at the management's discussion, they acknowledge several challenges. They mention the difficulty of getting capital in the current environment for startups. They also highlight the burden of being a public company with increased reporting requirements, like Sarbanes-Oxley compliance, which takes time away from implementing their business plan. And here is a little tidbit for you. As a smaller reporting company, they are not required to go into detail about market risks. This means they are not providing detailed information about how things like interest rate changes or currency fluctuations might impact them. One of the most interesting parts of this report comes with their mention of these Groovy Rewards tokens and Pinya Meme tokens. They are very clear that these are not securities. They call them utility tokens for gaming and social media, or digital collectibles. They go to great lengths to explain they have no inherent monetary value, no ownership rights, no profit sharing, and are not investments. This language is often used when a company is trying to distance itself from potential regulatory scrutiny. They're essentially saying, don't think of these as stocks or investments, they're just fun digital things. They even mention the SEC guidance on meme coins and state that while they believe their tokens don't constitute securities based on current law, there is no guarantee regulators will agree. They acknowledge the high volatility and speculative nature of meme tokens. They also mention holding 40 to 60% of the Pinya token supply for rewards redemption, which exposes them to price fluctuations. Now, let's put on our investor hat and think about what this all means. Pineapple Express Cannabis Company appears to be in a very precarious financial situation. They have minimal revenue, increasing expenses, significant liabilities, and a substantial deficit. The fact that they have zero cash on hand and an explicit statement from management questioning their ability to continue as a going concern are major red flags. The convertible debt with a 200% penalty on default is particularly concerning and suggests they may have struggled to secure financing on better terms. The extensive disclaimer around their tokens suggests they are actively trying to avoid being classified as issuing securities, which would invite significant regulatory oversight. This is a strategy many companies in the crypto and digital asset space employ, but it doesn't erase the underlying financial realities. The lack of robust internal controls further adds to the risk profile. What is the story here? It looks like a company that is heavily reliant on external funding to operate, with a business model that is struggling to gain traction, evidenced by the lack of revenue. The significant debt obligations, especially with those harsh default terms, create a constant pressure while they talk about AI, blockchain, and tokens. The core financials tell a story of financial strain. It is a high-risk situation. The company is trying to build something in a complex and regulated industry, and it is facing significant financial hurdles. There are opportunities in the cannabis tech space, but the execution and financial management here raise serious questions. Based on this report, it would be a very speculative investment, if at all, and one would need to see a clear path to profitability and sustainable revenue generation, along with improved financial controls before considering it. Alright, that is our deep dive into Pineapple Express Cannabis Company's latest report. What do you think about their financial health and their token strategy? Let us know in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe for more in-depth corporate analysis. Don't forget to check out our Discord community linked in the description for more discussions. Thanks for watching Corporate Decoder, and we'll see you in the next one.